Structural US dollar weakness has been the major theme for 2025.
Yes, it has.
And we do expect that this is likely to persist in 2026 as the US cuts rates further to support a weakening labor market. This will likely result in further inflows in 2026, flush liquidity conditions in the Sing market in 2026, and continue to be supportive for Singapore bonds.
Hi, good morning, viewers, and welcome to episode 3 of Unscripted in conversation with Eastspring Investments in our beautiful home location in Singapore. I'm delighted to have with us Ben. Ben's one of our senior portfolio managers on our award-winning fixed income desk in Singapore. Ben, great to have you on the show.
Thank you, Salman.
Thanks for joining me. Let's walk and talk, Ben.
Sure.
So today we're going to come home, really bring it all close to home, which is Singapore bonds. We're seeing very high demand for Sing bonds by investors. Tell us a bit about that, Ben. Why is that happening?
Well, the Singapore bond market generally does well against global comparables, mainly due to strong fundamentals as well as favorable demand and supply dynamics. But one big reason why the Singapore bond market has done exceptionally well this year is because of inflows. The dollar has weakened considerably this year on the back of slowing US growth, trade, and policy uncertainty. The Sing dollar has appreciated about 5% against the US dollar this year, leading to inflows, flush liquidity conditions, lower Singapore rates, and the stronger outperformance of the Singapore bond market.
Wow, okay, so that's a confluence of factors.
Yep.
Do you feel there's an element of carry in there as well when we see in some bond markets, or not so much?
I would say that the element of carry now is slightly diminished given the capital appreciation we've seen in Singapore bonds this year.
Okay.
But at use of about 2.7% Sing bonds right now, that is still comparable to dollar bonds on a hedge basis.
Okay, awesome.
Yeah.
The Singapore bonds generally have been one of the best performing bond classes within fixed income. What's the upside? How do you see it going forward?
Well, structural US dollar weakness has been the major theme for 2025.
Yes, it has.
And we do expect that this is likely to persist in 2026 as the US cuts rates further to support a weakening labor market. This will likely result in further inflows in 2026, flush liquidity conditions in the Sing market in 2026, and continue to be supportive for Singapore bonds. We think the case for Singapore bonds is strong. Even if yields remain range bound from here, downside risks are limited and income returns have stabilized.
Okay, well, look, really compelling answers. And Ben, I always ask this question from our wonderful colleagues. You're part of our award-winning fixed income desk in Singapore. What gives you and your team the edge? What's the superpower?
We strive to deliver consistent and superior risk-adjusted outcomes for our investors across market cycles. Our edge in the Sing dollar space, I believe, what comes down to 3 main factors. The first factor is we do have a robust research platform with dedicated Singapore bond resources. And this is especially important given up to 20% of the Singapore bond market is unrated.
Intrigued,
Yep. Secondly, we have very, very strong connectivity to the Singapore bond ecosystem. This gives us superior access to both primary as well as secondary markets.
Okay.
And lastly, I think what really makes us stand out is we have a comprehensive suite of proprietary risk analytics that allows us to effectively assess and manage our risks through market cycles.
Excellent. Those are very compelling reasons. I'll add a fourth, which is just wonderful colleagues who are on our desk who work really, really hard. Ben, great to have you on the show. Thanks so much for your time today.
Thank you, Salman.
All the very best. Take care.
Thank you.
Thank you.